Success in Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome back. This is Kerry, Lutz. You are listening to the Financial Survival Network. Hope everybody had a great holiday, whatever it might be you're celebrating, and you enjoyed the blood moon. It was spectacular. I was out west in Arizona where not much humidity, not much pollution, and it was spectacular. John Rubino is with us for our Monday morning discussion. And blood moon, well, is that what's going to happen to the stock market? Because everything is slowing down, as John has written. John, how are you?
Good, Kerry. How are you?
All right. Hey, ready to really hit the ground running, to say the least. And John, everything is slowing down, right? The U.S. was the world's great hope. And what's happening here, huh?
Well, that's what it's looking like. Basically, to set the stage for this, some really impressive stats, I don't know if impressive is the right word, but big numbers have come out in the last few weeks showing what we've done financially in the last 5 years. For instance, instead of deleveraging after the debt-driven crisis of 2008, 2009, the world took on $57 trillion of new debt. We basically just ramped up our borrowing. And at the same time, most of the big economies cranked up their printing presses, produced a lot of new money. And in the U.S., for instance, M1, the basic money supply almost doubled from 2010 to 2014. And with that kind of stimulus, huge amounts of new debt being taken on and lots of new money being created, you would think, according to mainstream economic theory at least, that our biggest problem right now would be too many people getting massive raises at work and spending all that money and causing inflation to spike. But that's not the case. Actually, most of the big economies are slowing down lately. For instance, Japan has this thing called the Tenkan survey, which shows business optimism and manufacturing plans, and it is plunging right now. Japan's businesses are investing less and less and growing less and less lately, which implies that the overall economy is going to slow down from here. And China just came out and announced that their growth rates aren't nearly what they were expecting for the coming year, and that they might fall below the crucial level of 7%. That was their target, and that's the generally accepted rate at which they remain stable. Anything below that, and they have a lot of problems with workers needing jobs and not being able to find them, and taking to the streets, yada yada. Right. Traditional Chinese labor unrest, and it looks like they're not going to meet that target either, and which isn't that big of a surprise because they borrowed a big chunk of that $57 trillion and invested it probably unwisely in a lot of cases, with ghost cities and airports with no planes coming and going. And so they are also slowing down in a way that has them very nervous. And meanwhile, the U.S., our last jobs number kind of fell off a cliff. We were having this brilliant jobs recovery where everybody was getting hired, and we were adding like 250,000 new jobs every month. And well, it fell off to half that in the latest report that came out on Friday. And then they revised some of the previous months down as well. So it looks like we're growing a lot more slowly than we thought, because really it was all about jobs lately. All the other numbers in the U.S. were kind of weak. Home sales were tepid, and manufacturing new orders were falling, and everybody was pointing to jobs as the real number. That was what was really happening out there. We were actually growing because we were adding so many new jobs. Well, that's not the case either. And so it looks like most of the big economies are actually slowing down and maybe trending towards zero and below. And that's extraordinary given the kind of stimulus that we have put in place over the last 5 years. You borrow $57 trillion and you expect some growth from it. And it looks like that's not the case.
Yeah, you would think you would get a little bit of growth, but we know that there is a concept in economics called diminishing marginal return or diminishing marginal utility. And eventually you throw enough debt and it stops working. And have we hit that point?
Well, that number, in other words, the bang for the buck, when you borrow money, how much new growth do you get from it? That number has been trending down for a couple of decades now. because you after a certain point, new debt just doesn't do you that much good. And that's where we are now. And in a big way, I mean, we borrowed a ton of money and it didn't really seem to work. And so the question becomes then, what's left? What tools do we have if creating lots of new money and borrowing lots of new money don't do it for us? And one school of thought is that, we just didn't borrow enough. If we borrowed $100 trillion instead of 57 trillion, then we'd be growing like crazy and adding new jobs. And so our next step in terms of policy is just to ramp it up. And that's probably the argument that's going to win because there's really nothing left. I mean, the opposite of that is austerity, where we say, all right, it's time to live within our means and scale back government spending and money creation and borrowing. And that's sort of the peripheral Eurozone model where that's what Greece has been trying lately, and we see how that's worked out. Yeah. But interestingly enough, though, speaking of Europe, that is the one area that's actually growing relative to the rest of the world right now. And the last set of numbers that Europe has been putting up have been decent. It seems like Germany's growing well and it's pulling along the rest of the Eurozone. And so the question then becomes, what lesson can we draw from that? Why is Europe doing relatively well when they're really, in a lot of ways, a basket case? They have all these problems, and yet they're growing relative to the U.S. and Japan and China. And the answer is that they are the ones who have aggressively devalued their currency over the last year. The euro is down by about a third versus the dollar, and by significant amounts, the lesser amounts, versus the yuan and the yen. And that devaluation has given them something of a trade advantage in the rest of the world because they price their stuff in euros, which means they're able to offer 1/3 lower prices when they're selling to the U.S. And that seems to have helped. They're stable to an extent and growing to an extent, depending on the country that you look at. And so the lesson that we all have to draw from that, or that we all will draw from that probably, is that everybody else now needs to devalue their currencies versus the euro. So it's the basic currency war theme playing out here. The U.S. let its currency go up in value by a third versus the euro and by quite a bit versus the rest of the world. Now we're slowing down. And that's because our stuff is more expensive to sell to the rest of the world, and our debts are harder to pay back because we're having to pay them back in appreciated currency. So what we're going to have to do going forward is address this. So you shouldn't expect the Fed to be raising rates anytime soon. And if they do, it'll just make things worse and they'll have to take it back. And it's very possible that we end up cutting rates from here and increasing the amount of money that we're creating and putting out into the world, because that's how you devalue your currency. And if that's all we've got left, if that's our only tool to avoid a recession, we have to do it, because a recession at this point, with interest rates already at historically low levels and debt at astronomically high levels, a recession, a garden variety recession, can turn into a crisis very easily. Stock prices in the U.S. are priced for perfection, which is to say steadily growing corporate profits. And if the economy starts to shrink, then corporate profits necessarily have to shrink. Companies can't make any more money if they're trying to sell into a shrinking economy. And we're seeing that already. Corporate profits fell in the U.S. in the fourth quarter of last year, and it looks like they're going to fall again in the first quarter. And that's a reflection of a slowing economy, as well as all the games that companies have been playing with their earnings, which have limited lifespans. You can only manipulate your earnings using accounting tricks for a while before you basically run out of room to scam your shareholders and other investors. And it looks like in the U.S., corporations are starting to run out of wiggle room. You can only buy back so many of your shares with borrowed money before your balance sheet gets way out of whack and you run out of shares to buy back.
You wind up with a leveraged buyout effectively, right?
Basically, yeah. I mean, that's where a lot of these guys are heading. They're borrowing huge amounts of money because interest rates are cheap, and they're buying back a lot of their stock in order to not have to pay dividends. They're making positive cash flow on this trade, but it's at a cost of their debt levels going going up and up and up year after year. And their outstanding equity base going down and down, and those lines, when they cross, like you said, it's a leveraged buyout. You've borrowed money to buy back all your stock. Now you're a private company. And these guys don't want that to happen because at that point, they're an incredibly highly leveraged private company. So they're at risk of bankruptcy, where, that's completely unnecessary for a big company that can issue equity and have a nice solid balance sheet because they've issued a lot of equity and used it to pay off debt. That's where you want to be in the long run if you're a major corporation. These guys have been, over the last few years, playing financial engineering games in order to pump up their share price and make stock options more valuable and year-end bonuses bigger and all the rest. And they can't do that forever, and it's harder and harder to do that in the face of a shrinking economy. So we're reaching several different kinds of walls here where you can't go beyond a certain point, and they're all coming at once. The global economy has borrowed an awful lot of money, and there's a question about how much more we can borrow. Corporations have borrowed a lot to buy back their stock. There's a question about how far that can go. Corporate earnings as a percent of GDP. This is an important indicator because historically and basically intuitively and physically, there's a cap on how much companies can earn in relation to the size of the economy. Because when corporations get too profitable, their workers demand a cut of this, torrent of new money coming in, and they get it. They have the power to, and so you're seeing that around the country right now, where people are demanding a higher minimum wage, and fast food workers are going on strike, and McDonald's is being forced to raise wages, and so is Walmart. And so that cuts into corporate profits. It might increase consumer spending to a certain extent, but the immediate effect is that it makes these companies earn less because they're paying more out to their workers. And so corporate profits then fall in relation to GDP to come back into a normal range. Well, we're at an extremely abnormal point right now. Corporate profits are much, much higher in relation to the size of the economy than they are in normal times. And that usually presages some kind of a turn down in corporate profits because they're as high as they can be, so there's nowhere to go but down. And some other indicators that are similar to this but also have a big impact on the future of the economy are equity market capitalizations versus GDP and financial instruments in general, add it all up in relation to GDP. And both of them, their value in both cases has reached a point where it's much higher than historical norms in terms of the size of the economy. So we've basically seen a financialization of the U.S. economy and to an extent the global economy, where financial instruments have gotten more and more valuable, more and more important in relation to, say, manufacturing and construction. And that historically doesn't hold. You reach this point where financial instruments are grossly overvalued by historical norms, and then they have to come back down. And so we're at that point too. So we're at the end of a lot of long trends here. And the question now is, can we go further and further into historically overvalued territory? In other words, is this time really different? Can we keep going beyond these points where we've never been able to go before? Or will something happen as it has always happened in previous cycles to bring things back to normal? In other words, will we have a mean reversion here that kind of resets the clock back to levels that are historically normal? And I would say that there are a lot of, black swans, a lot of catalysts out there that could easily reset the clock. And so we'll see. But right now, it looks like we've gone an awfully long way out into historically unprecedented territory in terms of all these big indicators: corporate profits as a percent of GDP, equity market value as a percent of GDP, and all the rest. And so that we're nearing the end of this cycle. Whether the end of the cycle is now, it could well be because corporate profits are going to fall for the second consecutive quarter here, or something happens to give us another year of breathing room. Maybe they cut interest rates in the U.S. and aggressively push down the value of the dollar, and that pumps things up for a little while longer. Who knows? But we're definitely, based on historical precedent, close to the end of this cycle.
It sure looks like it. It's been going on for a long time, and the benefits to the country as a whole, to you as the individual, you got to wonder what they really are here, right? You got to wonder, John. Yeah, for Wall Street, they look great. But, in reality here to the country, I think it's been devastating. And many of you think maybe they're good, but you're going to find out that not so good, right?
Well, yeah. I mean, the reason consumer spending, for instance, isn't going up the way economists predicted that it would with all the new jobs being added is that the new jobs being added are kind of crappy jobs. They basically just get you by, if even, and that's it. Meanwhile, the managerial class is seeing huge wage gains. Supervisors are making lots of new money, but they're a relatively small part of the economy. So if you just look at gross number of jobs created, that gives you an unrealistic picture of how good things are out there. And if you look at what kinds of jobs are being created, then you see that it's mostly low-paying jobs that in a lot of cases are the second job that somebody's got to take on because the first job was also a low-paying job and it doesn't do any good for them. And so, of course, they're not going out there and borrowing lots of money to buy new houses and take sweet vacations and eat in high-end restaurants. That's just not something that you do when you're working two jobs. One of them's a bartender, the other one is a morning job at McDonald's. You basically come home and collapse in exhaustion when that's your life. And that's a bigger and bigger part of the population right now. So the employment picture, if you dig down, is not nearly as impressive as the gross number of jobs being created makes it seem. And now the gross number of jobs being created isn't even impressive anymore. So the last 3 months have been a downtrend, and there really isn't any catalyst for it to pick back up. There's nothing out there that's going to goose hiring, especially not in well-paying jobs, because the oil sector is still laying people off, and that was the source of the really good-paying jobs of the last 5 years. And so now with fracking imploding because oil prices are so low, you're seeing a reversal of this. Lots of people are getting laid off in the oil sector. It's up into the hundreds of thousands in Texas right now, and then you got the Bakken oil field and the rest of the fracking complex out there, like Pennsylvania and Ohio, hired a lot of people for fracking in the last few years. Well, they're going to be laid off now. And so there isn't any real catalyst out there to pump up good jobs, which means that consumer spending can't really grow much in the year ahead. And consumer spending is what drives corporate profits. So corporate profits can't really grow. Corporate profits drive equity valuations generally. And so if corporate profits are falling, how do stocks stay at these levels? I don't know. It looks like the dynamic involves a lot of self-reinforcing cycles all pointing down. And we will see if there's something that short circuits this process. But right now, there's nothing on the horizon.
We've felt, you and I think, for quite a while that something's really wrong with the economy, right? Haven't we felt this way? And that things are not going to end well. Now the trends are really turning around. I think we're seeing this. And where are all the economists who said, everything's fine, don't worry about it, keep buying stocks, stocks are only going up? I think these are the same people that said houses only go up, hawk your living room, hawk your kitchen, and buy more stocks, right?
Well, in any big trend, the dominant mainstream prediction among economists is an extrapolation of that trend. That's just the way it goes. So, whenever anything's going on, you get all of these economists who should know better just saying, okay, next year will be 2% more of whatever's going on right now, and that's basically what you see out there in general among the economics profession. And the reason for that is that's the safest bet, because in most years, the most accurate bet is to simply project the current situation into the intermediate future. You say the next couple of years will be like this year. And most of the time you're right. So it's a really safe bet for an economist to do this. But that, of course, misses the big turns. And so, Kerry, you and I have been predicting a big turn for a long time because debt levels have looked unsustainable for years, and all of the other behaviors of the world's governments and to an extent corporations have been so clearly dysfunctional. that it looked like it couldn't go on, but it has gone on for longer than it looked like it should have. And so our predictions of a trend change have turned out to be wrong. And the mainstream predictions of the trend continuing have been correct. Now, that won't always be the case. At some point, this trend has to reverse. And, as we talked about, it looks like there are a lot of reasons for a trend reversal here pretty soon. But to me, it's looked like there were a lot of reasons for a trend reversal since like 2011. and so there's no guarantee that it happens this year because we're kind of in uncharted territory. We've never seen interest rates this low around the world. There are $2 trillion worth of bonds in Europe trading with negative yields. There are bank accounts all around the world with zero or negative yields. And there are levels of debt being accumulated out there that are just insane looking. The numbers are so huge that it 5 years ago would have seemed impossible. And yet here we are doing it. So it's not clear what the theoretical end is now, because we've pierced a lot of theoretical limits, the zero bound on interest rates and debt as a percent of GDP around the world. They're more extreme than they've ever been. Therefore, maybe they can be even more extreme. There's no way to tell what happens in the short run. But I think it's pretty clear that if this keeps going on for much longer, the imbalances get so big that something horrific happens.
Yeah, I think that's really it, that we're in the land of imbalances here, and they're increasing, not decreasing, right?
Yeah. And the numbers just keep getting scarier and scarier. And historically, bubbles have kind of had a surprising longevity. Their last couple of years always come as a surprise to analysts who look at historical numbers and say, well, okay, this is the end. Tech stocks can't go up beyond their 2000 or their 1998 levels. All right, this is the end. And then they double again in 1999, and that's the kind of thing that happens over and over again. And one of the signals that we really have reached the end is when the guys who were calling the end a couple of years previous shut up. They just get tired of the abuse of people saying, yeah, but you said things were going to fall apart. Look, way back then, and you were so wrong. I would have lost a fortune if I'd listened to you. Or I lost a fortune because I did listen to you. It gets hard to hear that. And so you see these voices becoming quiet. And some of that's happening now. You see people who used to be out there being interviewed all the time and saying, this is the end. It's time to short the market. It's time to short treasury bonds. And you don't hear that much from them anymore because they were wrong. And that frequently signals the end of a bubble, because then there's nobody left on that side. Everybody's on the positive side. And that's one of the stats that you see every once in a while now is the optimism, pessimism gauges in the stock market showing almost 100% optimism. And that's another signal that the end is near. So I don't know. I wouldn't predict that it happens this year, but I definitely see a lot of things that you can point to and say that the end is approaching.
Agreed. And hey, make sure you go over to John's site, dollarcollapse.com. And as always, you'll find a link in the show notes to our site, on our site, financialsurvivalnetwork.com. Sign up for our newsletters, our mailing lists, and get ready for the webinars. They're coming. Promise. John, we will talk to you next week. You be well.
Thanks, Kerry. You too.
FSN Radio. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.